Hello, everyone. Good afternoon, ladies and gentlemen, and welcome to our webinar, Home Buying and Selling. Our presenter today is Josh Waxman. So thank you and welcome, Josh. He has lived and worked in the Capital Region since 1993 and has been recognized as Best of 2019 by Washingtonian Magazine for his excellence in real estate as a platinum agent. He works tirelessly, has a wonderful work ethic. He's always analyzing market data and trends and making sure that his value clients receive the latest and the most relevant information to help him make the best real estate decisions. Josh will be starting the presentation shortly, so I know everyone's extremely excited, but a couple of housekeeping items. One, this webinar is going to be recorded, and the presentation and the re-recording will probably be sent out next week to everyone that is attended. At the end of the webinar, I will be presenting a survey link, so make sure your opinion is very valuable to us. So make sure you please fill out that survey link. And then if you have any questions, there's one last housekeeping item. If you have any questions, please make sure you put them in the Q&A bubble at the bottom of your Zoom screen. It's the one bubble with the two little bubbles. That way we can answer your questions from a lending perspective as well as from a real estate agent perspective. Without further ado, I'm going to pass it on to Josh to take you through the presentation. Thank you, everyone. Josh, the floor is yours.
Great. Thank you, Marilyn. And thank you, participants, for coming to the webinar. It's very exciting for me to participate with our Smart Move program with the Inter-American Development Bank. I very much look forward to meeting people face-to-face back at the IDB, hopefully one day, whenever that is. And I'm going to run through the home buying process for you. Some of you may have purchased a home before, and so some of this will be a refresher for you. And many of you may never have purchased a home, and so this will be a lot of new information. I'll also run through the home selling process for you, and I'll go through also some market data for you. And that specifically includes what's been going on in this last year with the pandemic. If you can believe it's actually been a year now. And so there's a lot of, year-long worth of data regarding the pandemic, which is interesting to say the least. And so we can talk a little bit about that. I'll go through our Smart Move program a little bit with you as well on this slideshow, and then obviously open up to Q&A that we'll do as well. Also with us are some of your colleagues with the IDB Federal Credit Union, and they can assist also along with me in answering any questions regarding loans. So we'll go through that a little bit too. So one thing I like to start talking about with members at the IDB is when to buy and when to rent. And I feel that many people coming to Washington, D.C. for jobs with the IDB have this question on their mind very much. And I've gone through over the years a lot of analysis, particularly with your colleagues at the IDB, to try to fine tune as best possible the right answer to this question. And what I've outlined some important things that we've looked at in this slide right here that you're looking at, but in trying to sort of make it easy for everyone to understand, based on all of the data over a long period of time, I've able to simplify this into a basic rule. Now, it's not always one size fits all, but in this case, I feel as if you use a 5-year window to answer that question. So if you are moving to the Washington, D.C. metropolitan area, and you've signed up for a 3-year job, which is often the case, and you're sure at the end of the 3 years you will be leaving the area, either for a new metropolitan area entirely or to go back to a city where maybe you've lived before. If you're confident that that is the case, then in that situation, it is probably best to rent. That way, you don't run the risk of getting caught up in a situation where there might be a slight downturn in the market, or you'll have real estate fees with 2 transactions that might eat away at whatever equity you've built into the property. So If you know you're leaving in 3 years and you're not going to keep the property, then it's probably best to rent. If you know you're going to be here for at least 5 years or possibly longer, it's usually best to buy. I have talked to many people over the years who have said, well, I'm not sure if I should rent or buy. And I have said, well, how long have you been here already? They've said 8 years, even some people over 10 years. And obviously, in retrospect, they think, gosh, I wish I bought, 8, 10, or 12 years ago. Nonetheless, this is kind of the rule. One thing to note about this rule is that it is not a matter of living in the property for 5 years or longer. It's really a question of ownership. So if you're going to be here for 3 years, but you'd like to possibly keep the property as an investment property and rent it out and move on to another place and still own the property for 5 years or longer, then it's also a good idea to buy. It is only in that window, if you plan to buy or sell, that you run the risk of losing money. Even in a flat market, as you pay down principal over a long period of time, you will still almost always do better with the purchase in a long period of time, because you'll be spending money in housing every single month on rent. So it's usually a good idea, if you're not sure, to use my 5-year rule as sort of guidance. I can say there's one slight exception to the rule, is if you're totally unfamiliar with Washington, D.C. at all, and you're not sure exactly where you want to live. Obviously I'm happy to have a conversation and help guide you through that, but sometimes it's not a bad idea to sort of land on your feet and spend the first 6 months or even the first 12 months renting, not because it's a great financial move, but sometimes it's not a bad idea just to get a sort of lay of the land, if you will, as to, your commute to work, although right now everyone's kind of working from home, so that takes on a lesser meaning, but maybe that will change in one day. And also just to get a sense of, schools or, activities or other conveniences. So sometimes it's not a bad idea to spend a little bit of time familiarizing yourself with any area that's completely new. And that is not really a financial move, but that's more of a move to sort of understand the market. And I'm happy to talk more about this with anyone, but I put some bullets in these slides here for you to understand, but really it comes down to that rule, what I can see with most members at the IDB. So let's say we've moved past that and you're interested in purchasing a home, whether it's a condo, a co-op, a townhouse, a single family home. The first thing that you need to do is talk to someone at your credit union and get a pre-approval letter. What that means is not that you're formally approved all the way to purchase a home through underwriting, but it means that they've taken a cursory look at your overall credit worthiness, your debt to income ratio, and they've decided along with you what your purchase capacity could be. It doesn't mean that if they tell you you can buy a home for $1 million, you're comfortable spending that, but it tells you what your max purchase price would be. And it also gives you your payment plan as an estimate. No mortgage loan provider can lock you in on an interest rate until you actually have a ratified contract. And I'll get to that in just a couple of slides. But they can just tell you what it would be on that day. And then we can also factor in some things based on homes, what property taxes might look like. And if it's a condo, what condominium fees might look like as well. The next thing to do is learn the market. And here's where I can help a lot, whether it's Maryland, Virginia, or DC. Our Smart Move team knows all of these markets very intimately, and we can really help guide you on this and answer any questions for you on that. A couple of things that are important is doing what we call a competitive market analysis and building that for you so you can really see the sales, similarly to the way an appraiser might make a report. So doing a CMA is very similar to an appraisal report, although not officially an appraisal report. let me move on to our next slide here. So choose a professional. So depending on where you're looking, our Smart Move contacts will connect you with me or one of my colleagues that's an expert in your area, depending on where you're looking at purchasing, and we can help guide you in those markets and determine the best way to write an offer. And depending on, right now, and I'll talk about that a little bit later with the slides, but right now, the DC metropolitan area is a very, very competitive real estate market, which is interesting because it's something everybody sort of held our breath as we were moving into the pandemic a year ago and didn't know what to expect. But as it turns out, people still need to live somewhere. In fact, in some ways now more than ever, it's taken on an importance because people are spending a lot more time at home. They're living and working from home. So definitely a very unique situation. And then, of course, with interest rates being historically low as they've been, certainly makes for a very competitive market. So when deciding once we've found a home, writing an offer that could win you the property is something that we work on very carefully. Once we won the property, and what I mean by that is you've gone under contract. In this area, we call it a ratified contract. And in the contract, there's actually a space where it says date of ratification. So that's an important date where all the contingencies start from. And I'll come to that, I think, in the next slide. Then you work on securing the loan. And that's after the pre-approval process where you go through underwriting to obtain a loan. And then we'll be at the settlement table at the end. And there's a number of steps along the way, which I will talk through with you right now. So I included this slide, and it's kind of a fun slide, I think, to look at. Maybe you could spend some more time if you want looking at this slide after the presentation. But in here, we've kind of stepped you through in a circle from 1 to 14 with our steps to go through everything that can that would normally happen in a home sale process when you're purchasing a home. So one thing that I get asked by home buyers often is, how long does this whole process take? And maybe you've wondered that yourself. Maybe you've never purchased a home, or you've never purchased a home in this area. And so I will answer that question in this way. If you look at the slide, this slide, and it starts with number 1, which is an initial consultation. And that's sort of when we have a one-on-one session, whether that's in person or through Zoom, and we sort of meet and greet, talk about, what you want in a home. And then we get to number 6 right away, and you see that's sort of grayed there, and it says contract accepted. So from number 1 to number 6, and that's when you get the pre-approval letter, we determine what you want in a home. We go out and, we probably start first online, going back and forth, creating a database of homes that you like. We make lists of homes. We go out and have real fun, which is on the journey and visiting properties in person. And then we make an offer, and the offer could have a variety of contingencies based on how competitive we think it is, usually home inspections, appraisal contingencies, financing contingencies, even contingencies by law that have to be included on condo doc reviews, co-op doc reviews, homeowners association reviews. So once we get a contract accepted, from 1 to 6, there is no number. That could take a day or a week. It could take months or a year. Honestly, that's just on your time frame from the time we first talk until you have a contract accepted. There's no right or wrong time frame for that. However, once we do get to number 6, and I'll go through these other steps in just a minute, but once we do get to number 6, which is contract accepted, I can tell you right away where we go from 6 to 14, because in the DC metropolitan area, which is different than some other markets like New York, it's totally different. We do, in fact, have fixed settlement dates. So when we write a contract, on top of things like we're going to offer this much money, we're going to put, maybe 20% down, we're going to include a home inspection contingency, all of these different factors, we're also going to include, hey, we're going to go to settlement on June 1 of 2021. So by the time we get number 6, a contract accepted, we already have in writing when that settlement will occur. So it's an important thing to know that 1 through 6, nobody knows. From 6 to 14, we have a set date, and that set date is usually somewhere around 4 to 6 weeks. So all of these other items from 7 to 13 will happen in a period of about 4 to 6 weeks from contract acceptance. So let me quickly go through these other steps with you. So once we get a contract accepted, the first thing that we're going to do is collect the earnest money deposit, right? So what is that? That is your money that will be held in an escrow account by the settlement attorney. It is a portion of your down payment. So it's usually somewhere around 3% of the sales price, and it will be held by the settlement attorney, who will open an escrow account that is specific. It's a specific account for your transaction. It's for you buying, said property. So they open that account and they stick your earnest money deposit in that account, right? Later on, all the money that is going to be sent by the lender, by the credit union, for your purchase, it doesn't get sent to the buyer. No money gets sent directly to the buyer, to the seller from the buyer. It gets sent from the lender to the same escrow account. So the escrow account starts out with your earnest money deposit, and later it gets funded with the money from the loan. And then before settlement, if there's any more money needed, the remainder of your down payment or any outstanding closing costs, that gets put into the same escrow account. So you will have a big pot of money right before settlement in that escrow account. Then the settlement attorney, from that escrow account, they will have done a title search to make sure the seller is in fact the owner of the property. They will find out in that title search if there's any liens or mortgages that are owed against that property. So from that escrow account, they will pay off mortgages, liens, taxes, anything else, so that they can sell the property to you and ensure clear title to the property. And with that, they will sell you, as part of the closing costs, title insurance, so that you have a guarantee that they will record the deed in your name or in the name of you and your spouse or whomever you're purchasing the property with, sell you title insurance and pay off any lien holder on that property, so that only the remaining funds from that escrow account will then be transferred to, released to the seller. So that's a very important step in this process. And it starts with the earnest money deposit. After that, we go to the home inspection, right? The home inspection, it's an interesting process because, you as a home buyer will hire the home inspector. The home inspector is working for you. It's important that you never, accept or allow a home seller to purchase the home inspection for you or give you a report they had done, because, you want to know that that inspector is going to be working in your interest and finding out anything that's wrong. I always say, if you don't move forward with a purchase, the $500 or so you spend in a home inspection is the best money spent, because you can void a contract, you get your earnest money deposit back, and you have no penalty if there's a real problem discovered in the home inspection. You're not putting yourself out there for great risk other than the cost of the home inspection, right? The next portion is the appraisal, right? The appraisal is ordered by your lender, and the appraisal is done by a third-party licensed appraiser, and they go to the property, they take measurements, they run their own appraisal report, similar to my competitive market analysis, but theirs is for the bank. And the important thing to know about the appraiser is they have no vested interest in any of us. They don't have any interest in your purchase going forward or falling through. They're just there as a third party to make sure that the property is livable and that is it's worth at least the value of what you're paying. So what happens if the appraisal is low, right? Let's say you're buying a property for $500,000 and the appraised value comes in at $480,000. Well, a number of things can happen at that point, right? The best thing for a home buyer would be for the seller to agree to drop the price to the appraised value, and then you can move forward actually at a lower price. I've seen that happen. Another thing that can happen is you could say, well, I'm going to make up the difference in cash. I'm going to put an extra $20,000 down than I was planning, and I'm going to bridge that gap with money. Or the home buyer and seller can sort of make an agreement, new terms in between. Maybe they meet in the middle at $490,000. That could happen too. One thing to note about it, and I've seen this happen too, where a home seller drops the price to meet the appraised value and the home buyer still walks. One would think, why would they do that? It seems like that would be a great deal for a home buyer if the appraisal comes in low and the seller agrees to drop the price. Well, the answer to that is some people just get a little bit scared with a low appraisal, and contractually they have a right to do that. If they have a low appraisal, even if the home seller agrees to drop the price, they can still walk away. I'm not saying you should, but you still have a right to do that. I've seen it happen because some people just get scared with a low appraisal. Okay, let's move on. During this process, you'll have done your formal loan application, right? And you will be asked by your lender, who's being asked by the underwriters, to provide various documentations. And the purpose is to verify the information that you filled out in your original loan application. Typically, in a perfect world, with most offers, we include a financing contingency. Therefore, your earnest money deposit is still protected, even should something happen in this process. So, for example, loss of a job, death in the family, lawsuit, loss of income, all of these things could, add up to a formal loan denial, or sometimes what we call a failure of financing. Then we just simply your lender issues a formal letter of denial, and then your earnest money deposit is refunded, and there's no penalty in voiding the contract. So we're going through this process still. You're getting title insurance, you're getting homeowners insurance, lots of insurance is needed in purchasing a home. And then we finally do the pre-settlement inspection. That's usually done the day before settlement. And that can be a wide variety of things. So for example, if you're purchasing, let's say, a condominium, and the original inspection we went through and everything was fine, or maybe there was one or two very minor items, we'll just probably go back to the condominium together and check it out and see that things are done or things look good. If there were several items or any expensive items, right? And I've had this happen with a boiler once that wasn't working properly in a home. So anytime there's expensive items in the original inspection report, besides getting invoices for all of the repairs, we'll probably come back with the same inspector again to do a pre-settlement inspection. A little bit cheaper than the original inspection, but sometimes very, very well worthwhile. And then finally, we come to that settlement date. Most settlements, but not all, most settlements, you will get, you'll be able to occupy the property immediately after settlement. Sometimes, for various reasons, we have terms in the DC market called pre-settlement occupancy or post-settlement occupancy. So for example, it's possible the seller's moving somewhere and they need 2 or 3 days to stay in the property after settlement so they can then turn around and purchase their new property. And we have specific documents already pre-written to handle these sorts of things made by our local associations. Okay. I'm going to move on now to the home selling process. I think we're doing the Q&A at the very end, and I'll be able to answer all the questions, whether it's home buying or home selling. So let me move along with this. One thing I want to talk about briefly before I get underway, maybe I'll go back to just this slide here, since it's not on a separate slide, but maybe I'll make one for that, is something called FRIPTA, because I know it's something important for a lot of international homeowners in this country, and that is the Foreign Investment of Real Estate, Real Property Tax Act. And it was made in 1980 by the IRS here. And what that means, and it's a really important thing when selling a home to know about, because the government wants to make sure people who own real estate in this country who may have made substantial amounts of money do pay capital gains on that real estate, right? And I can talk to you more about capital gains. It's not a terrible thing. Remember, you only do pay capital gains if you've made a considerable amount of money, right? If there's capital gains exemptions, up to $250,000 exempted for an individual, up to $500,000 exempted for a married couple. So you have to make considerable amount of money to pay capital gains. But the FRIPTA tax law, what it does is it was created so people wouldn't sell real estate, make a ton of money, move out of the country, and not worry about it ever again. So what they said is, if you're selling a property for over $1 million, they want to hold back a full 15% of the gross sales price from the property to go to the IRS. You can get it back, and I'm going to tell you how to avoid the whole thing. You can get it back by filing taxes here that next year. If the property's under $1 million, in FRIPTA, they hold 10%. And if the property's under $300,000, you're exempt from the whole thing. They hold zero. So how to avoid all this mess, right? What you do right away, you tell me or you tell the settlement attorney, we're obviously working together, what's going on. They'll have you fill out a form, right? A tax code form. The settlement attorney will help you do it. They'll prepare it. It's very simple. And what will happen is the settlement attorney will escrow that money, hold it, meaning rather than sending it into the IRS. And when they do that, right, they can release it to you, I think 60 days later. So it's a much better system. Let's say you're selling a property for $1 million. That's $150,000 that would have to go to the IRS. And then you could get it back, possibly the whole $150,000, by filing taxes the next year. Or you could let us know in advance. You fill out some forms. Settlement company holds the same amount of money in escrow and then releases it a couple of months later to you. Much better system than going through the IRS and then waiting a whole year, probably getting it all back or whatever you're entitled to back anyway, but a whole lot longer and a little bit less control that way as well too. So I wanted to point that out to you because it's something really important to know. Okay, so let me move on to understanding the market here. So a little bit different than the home buying process, because understanding the market is very different when you're selling a home, because assumably, unless you've owned it as an investment property for a long time, you're living there, you purchased it at one point, you know the area, right? So we're not trying to learn things about the neighborhood. What we're trying to really learn is right here in step number 2, is we're trying to learn the property value. And the best way to do it, again, is my creating a CMA right here. We call it a competitive market analysis. And another thing I like to do also is visit some of the competing listings, actually go in a couple of homes, a few homes, as if you were a buyer, and taking a look at them and seeing what they look like. It's very easy for people to have an emotional attachment to their own property. I think I fall into that category myself, right? It's very easy to feel that way, but it's really important to focus on the data that we provide and get a sense of the true market value, because most of the time when we sell a home, what we find is if we overprice the home, it sits on the market longer and gets a lot of those dreaded days on the market that we never like to see for too long. So we like to, in our competitive market analysis, we like to look at sort of the average days on the market in your very particular community, and then how can we price it correctly so we don't have too many days on the market and we can yield the most amount of money for your home. Okay. The listing process and our team here, Long and Foster Smart Move program, is very astute. You know, we've been doing this for over 50 years and have a lot of incredible things we can show you going through a listing presentation, which I'm not really doing right now, but I just am talking about that briefly in the listing process, because nowadays there's more to it actually than years ago, because the internet and technology in general has just changed everything, and how we present homes, how we market homes. And so there's a lot of steps in that, and including preparing your home for sale. So I sold a home for an IDB member the end of last year, and we had to stage the property for them. It was a vacant home. So there's lots of different steps in really preparing the home for sale that we will go through with you. Obviously, this varies a lot when you're selling a home that you live in as your primary residence, right? But we still help you a lot. You know, so we make it so it's not too difficult to live in a home while selling, if possible. And we have a very robust network, you know, worldwide, wherever it is. So to help with all these steps. And oh, I want to mention this too, the Smart Move coordinators, and we'll get to that in a little bit, but they help with your whole move. So I know a lot of people at the IDB move internationally. So we're very accustomed to that, just like your credit union is very accustomed to certain things like moving large sums of money into this country to use as down payments or purchases. You know, we're also very astute at moving people internationally and even helping people purchase homes all around the world. So whether it's a move or a purchase to another country, that's not a problem. It's not new for us at all. So here's a slide that I thought was, I made that I thought was kind of, would be interesting to everybody, because I figured with the timing, now it's been a year, we can sort of, we have enough data to look back to just what was happening with this, with the real estate market before we all got hit with this awful pandemic to now, a whole year later. So this slide that I created was looking at data. It's very macro, right? So obviously this won't apply to any one person, but it applies sort of to all of us in the area to get a sense of the, you know, what's going on in the market in our region, right? And you'll notice, which, you know, nobody could have predicted really, but every single category, it seems that the real estate market is performing very well. I can talk to you more in detail about, you know, differences and nuances and certain hot neighborhoods, and, you know, how this stacks up with single family homes versus condos, and all of that's very important and interesting sort of on a one-on-one basis. But taking a sort of a macro look at the real estate market through the pandemic, it's really quite interesting. Every single category that we normally use to measure the health of real estate is performing very well. I mean, the only number you're seeing going down here is the average days on the market right here. So more real estate's been sold. Not just the numbers are larger, but actually the number of units sold are larger. The median sales price is up, and the days on the market, meaning how long is it from the first day it gets listed in the open market until the property goes under contract. It means the seller has accepted an offer from a buyer, not how long until it actually goes to settlement. As I mentioned, that could be another 4 to 6 weeks after that. So how long did the property actually take to go under contract? And that number's down considerably. When we look at this average sales price to OLP, which is the original list price, because sometimes it's confusing, because if properties are on the market for, you know, a month, 2 months, the seller might start to drop the price, right? So in this data, we're not looking at the final list price. We're really looking at the final sales price compared to the original list price, what they started out at. And you see that even these numbers are closer to 100 than they were before. Before they're around 95, 96%. Now we're getting up around 98, 99%. Now that also includes some properties, of course, will sell for more than the list price. That's not uncommon. So this is taking all of that into consideration as an average. So one thing that I'll mention here, the detached homes, particularly in our Washington, D.C. metro area, and townhomes included, are in fact in these categories outperforming condos right now. I believe this is a product of the pandemic. I'm just speaking to you now as someone who lives and breathes this literally 7 days a week, every day of the month, every month of the year, is that right now you're seeing single family homes that are, you know, a little, call it farther out, right? A little further out from where you used to have to go to work at the IDB every day, having bidding wars even, or spending less time on the market, or going for sales prices very close to the original list price. You know, I believe it's a product of the working from home environment, of not having to commute every day. So it's shifted a little bit during this year, and I think it will shift back probably in a, you know, maybe not in the next year after the pandemic, but, you know, assumably if things come back to normal, so will markets as well. Okay, so let me talk briefly for you about our SmartMove rebate program. You also get a lot of other benefits with a SmartMove coordinator that can help with all of the different things I've just discussed, from moving to insurance to making sure the process is going well with the loan. So your SmartMove coordinator is not a realtor, will sort of help guide you every step of the way with all those factors. But I want to mention this too before I get to my butt. My butt was about the cash rebate that you're entitled to. SmartMove has a website right here, smartmove.com. So really the first thing to do, beyond any of the other things I've mentioned, is to go to smartmove.com and just sign up. Put your name in, put your contact information in, and sign up. Because that way, whether it's now or sometime down the road, you're eligible, you're done, you're eligible for rebates, you're eligible for assistance, all that will be done. So probably the first thing to do before you do anything else is go to smartmove.com and sign in. Okay, so now I want to get into this rebate, and this example that we put is just, you know, a sort of typical example of the cash rebate. If you were buying a home in our imaginary example, and it was for $300,000, and the cooperating broker commission was 3%, you would get a cash rebate of $1,800, right? And the calculation's right there. Obviously, the more expensive home, the bigger the rebate. It gets sent out, they say, up to 30 days after settlement. I usually find it's done in the first week. We do not include it on the closing. What we include it as a line item just to note that you're getting the rebate, but you don't get the cash as a credit on your settlement. We send it as a separate check later. And the reason we do that is because sometimes when I'm working with a home buyer, we negotiate having the home seller pay all of your closing costs as a credit at settlement, so that you don't have to come up with any money beyond your down payment, right? However, if you're getting too many credits, right? Let's say I was able to negotiate a credit to pay for all of your closing costs, and then there's a rebate credit too. You can only get as much credits as the fees on your closing costs. You can't get more than that. So to alleviate any confusion or problem or too much in credits on a settlement, we put it there just so you see it as a note, and then we send the check out immediately after settlement. And last thing, is just my contact information is here. And I also included contact information for your IDB Federal Credit Union as well, because I'm going to, we're going to do some Q&A now, but I want to let people know that, don't feel that you have to get your questions out right now or think of things. Things can come to you, tomorrow or next week or next month. We are always here available for you. So I want to open it up. If there's any Q&A, I think Marilyn's going to help facilitate that.
Yeah, thank you, Josh. Great presentation, by the way. I appreciate all the insights that you had. Just as a reminder to everybody, I'm actually going to put the survey link in the panelists and attendee chat. That way that you can provide any feedback regarding this presentation after the meeting. And then additionally, you will also get an email. So as a reminder, like Josh mentioned, we are taking questions. Please put them in the Q&A bubbles at the bottom of the screen, the two little bubbles that you see. And as an added feature, we also have our lending team on the call. So they are here if you have any specific lending questions that you would like to ask, idbglobalfcu.org. I just said the website. So we have a question here. I would like to buy an apartment in Miami this year, Josh. And you kind of went over this a little bit, but if you could expand. Sure. Are there any online tools that can help me see the current inventory is one part of the question. And then the second part of the question is, can you suggest any good websites that help me figure out the best areas to live in and the best areas to avoid?
Absolutely. So let me answer that question for you. And this is true, the way I'm going to answer this question, this is true whether you're buying a condominium in Miami. Actually, it's funny, a past client of mine is in the process of buying a condominium in Miami right now as well. The best thing to do, honestly, is to reach out to me after the seminar. And what I will do with our Smart Move team, I will coordinate you. I will get you in touch with an expert in the Miami market, and that person will have a better insight than myself, who's an expert here in the DC metro market, to help you with whether it's third-party websites or particular guidance in that market. Because the specific tools that I have to use are really tailored for. They've expanded it. It used to just be Maryland, DC, and Virginia. Now I have insight and access into Pennsylvania, West Virginia, and some other places, Delaware, but not as far as Florida. So really, the best thing to do would be to stay within the Smart Move program, stay within the credit union, and then have us, connect you, and we can help with all of that involves, from moving to having questions answered about neighborhoods and other insights by an expert there who has different tools and a lot of resources and just a wealth of value and information on that market. And like I said, that's true regardless of where you're buying, whether it's in Miami or in another country.
Wonderful, thank you. A couple of more questions have come in since you've been speaking. So Josh, please speak a bit more about co-ops. I'm planning on moving to Baltimore, and there are a lot of those. Yes,
great question. I'm going to try to answer this as quickly and simply as I can. The difference really between a condominium and a cooperative, we call them condos and co-ops, is the type of ownership. So think of it this way. In a condominium, you're buying a condo in the same way you would buy a house. And from a real estate perspective, it's called fee simple. So you own the condo, the unit, just like someone would own a single family home. And then in buying the condo, you also have a shared common interest in the lobby, in the building itself, right? A co-op is totally different. A co-op, the building itself, right, owns the whole property. So the building, let's call it building, 123 Main Street company, that's the address of the building. That company owns the building. And as far as the city of Baltimore is concerned, 123 Main Street owns the building before you buy there, while you buy there, and when you sell it, the city of Baltimore is not involved in that sale. 123 Main Street still owns it. So what are you buying with a co-op? when you buy a co-op, you're becoming one of the owners of 123 Main Street. You're buying into the ownership of that association, and then your particular ownership of that unit is within the confines of the co-op, right? So you're one of the many owners of the company who owns the entire property, and your ownership is assigned to that unit within the property. How is this different than a condo? Well, it's different in a couple of ways, right? Because technically no real estate is being transferred in a co-op, they can have different rules. So for example, a co-op can say, we don't want to sell to anyone who doesn't put 20% down. You can't really do that in a condo. You're buying a separate piece of real estate. A co-op can make their own rules. Where it comes into play more often is with rental restrictions. Condos and co-ops both can have rental restrictions, but more often than not, you'll see more rental restrictions levied by co-op associations than condo associations. Co-ops, they can be more less flexible if they want. They can create whatever rules they want. Also in a co-op, which you can never do in a condo, is the final process in buying a co-op is you have to be approved by the co-op board of directors, right? Which sometimes is just the president, sometimes it's voted on by the board. And condo can't do that because there's a lot of restrictions with protected classes, et cetera, in a condo that do not apply to co-ops because you're buying ownership of a company versus a fee simple portion of real estate in the city. And so for all these reasons, it's very different. That said, I'm not trying to throw my hat to condos are better than co-ops or co-ops are better than condos. I'm just trying to explain the difference where one is you're buying a piece of real estate and the other is you're buying ownership in a company that owns a large amount of real estate and is assigning you a portion of it. So does that answer the question about it?
Yeah, that was great.
Okay.
We have one more in here. And again, I want to remind everybody that we are taking questions now. And also if you have any questions for our lending team, please send them over in the Q&A chat. So here's another question for you, Josh. Since single family houses prices have gone up this past year, would you expect them to decrease once people start returning to work? And would it be a smart move to buy a house now that prices are high or wait for a year to see how the market adjusts? That was a two-parter.
Yeah, it's a great question. Here's the truth about it. A couple of things. The prices of homes are being driven, I believe, by two different factors. One of them is the pandemic. Places that are considered further out, Potomac, Maryland, Great Falls, Virginia, are of particular interest versus a year or 2 years ago because people want more space and they're working from home. So possibly that would change. Another factor is the interest rates are incredibly low and possibly that could change. So there are a couple of factors that could make the prices possibly go down in a year. But the truth is we don't really know for sure. The market seems overall to be fairly healthy. When you have multiple bidding wars on single family homes that we've seen, a rise in interest rates or everybody going back to the office, you would think that would have some level of, decrease to the prices, but in my opinion, I think what would make the prices go down more would actually be interest rates, even more so than the pandemic, because people buy based on what they can afford each month, and the actual sales price is really just a product of that. So if you're buying something at 3%, you can afford, a lot more than if the interest rates were 5%. So I think looking at the pandemic and trying to figure out if the prices are going to go down as this goes away is one thing. I think interest rates are probably even more telling than that. But I don't think if you're planning on living in a property, getting back to my original slide with 5+ years, you're probably pretty safe if you're planning on holding on to the real estate for a longer period of time.
Wonderful. So I think that this next question is probably for Alejandra or Eric, if you're available. If you could put your mic on real quick. If not, Josh, I may pass it on to you. Okay. Do I need to have 20% down payment available by the time I request the pre-approval?
Hi, Marilyn. This is Alex. Well, we have the option to evaluate 10% down We also have what is called a supplemental housing loan for those who are staff that have termination benefits and have been working at the bank for at least 2 years to provide a supplemental loan of $40,000 with a really low interest rate. If you put 10% down, we will go with private mortgage insurance, but we have to evaluate case by case because we have to check credit score and the loan amount to see if it's eligible for mortgage insurance. But we have many options to offer to our members for purchases or refinances.
Thank you. Those are all the questions I see in the chat room. So I will wait 1 second before we close out. Josh, I want to thank you for your insights. It was a wonderful presentation.
Thank you.
As a reminder to the audience, we do have 12 webinars this year, so I encourage you to go to our website, idbglobalfcu.org, and take a look at the webinars that are available to you and sign up. As a follow-up, we will be sending this presentation probably about next week to all attendees, as well as the recording. So you have a lot of information for you at your fingertips. If there's nothing further, I will close out today. Josh, you have any closing words?
No, thank you again. And I think my only closing words are if anyone has further questions, my information's right there. So you're welcome to follow up on your own, or if there's things that you maybe didn't think of today that you'll think of tomorrow or next week, you know, we're available for you.
Thank you, everyone. Have a wonderful day and a wonderful weekend. Thanks for joining.